Alright, so we're back to arguing what it means to be in a recession. So we have to settle this debate once and for all because they asked the American people whether they thought we were in a recession, and I've got the results because this pie chart right here shows that 65% of people living in the US believe that yes, we are in a recession. That's shown in red. Now, the other 35% of people also believe we're in a recession, but shown in blue. Just kidding. Just thought I'd break the ice. Either way, the economy had a super important week this week and an even more important month because on October 27th, the Bureau of Economic Analysis, the BEA, is going to release what's called their advance estimate for their third quarter GDP. So here's what all that means. Remember, the GDP stands for Gross Domestic Product, and it measures how much stuff a country makes. We want this number to be as high as possible, but most importantly, we just want this number to be positive, not negative. Now, each GDP estimate has three of them. We have the first, or what's called the advance estimate, the second estimate, and the third estimate. Each one gets more and more accurate. Now, when we get the first, or the advance estimate, it's usually the most important one because it tells us what the economy's been doing, whether it's been shrinking or it's been growing. For now, economists are trying to do their best to predict what they think will happen, but in the meantime, here in the US, we're all arguing with each other what it means to be in a recession. For example, the president said that he does not believe we're in a recession.
Should the American people prepare for a recession?
No.
And that is sort of a half-truth, because on one hand, the president is technically right that a recession means more than just a negative GDP. It should also look at the jobs market, which for last month, in the month of September, was amazing because the economy added 263,000 jobs, putting the unemployment rate at a 50-year low, which is undeniably amazing. On the other hand, though, a recession has always been defined as two negative quarter GDPs back to back. And if you remember earlier this year, the White House put out a press release right before that second quarter GDP announcement that a recession isn't two negative GDPs back to back, and that's when people started fighting with each other over what it means to be in a recession, and now we're kind of back at it. But the bad news, though, is that there's a real chance that when we get the advance estimate for that third quarter GDP, that the economy could also shrink, and we could get a negative number, again, for the third time this year. And that's why Bank of America just put out a new warning saying that the US economy could start losing as many as 175,000 jobs per month starting next year, and that the stock market could lose another 20% from here, and that Bitcoin could go down to as low as $12,000 per coin. So that's a lot to unpack here, so let me explain exactly what's going on with jobs and how all of this will affect us, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the breakdown because there's some good news and there's some bad news. Now, the bad news is that inflation is still pretty high and there's going to be a lot of jobs that are at stake. The good news is that it's all going according to plan. So I'll help you explain exactly what this plan is, where interest rates are going to go because of this, and what this means for jobs because it's pretty mind-blowing. Because this week we got what's called the CPI, the Consumer Price Index, which is the thing that measures inflation. And that number came in at 8.2%, down from 8.3% the month before. So there's a tiny small difference and inflation is going down, but not by much. But it's that tiny difference, which is why the stock market was up over 2% on Wednesday, because it gives investors hope that maybe we've seen the worst of inflation. But the truth is, that's probably not the case because we've seen this play out before, especially because gas prices are now going up, which means there's a real shot that inflation could be even higher next month. So for now, the CPI number is down, which is good, but the core inflation metric, which is what economists like to call the PCE number, which removes both food and energy out of that equation, is again at a 40-year record high, from 6.3% last month to now 6.6%. And that means interest rates are about to go way higher. And the reason we know that is because we know what the Fed talked about in their last meeting in September at what's called the Fed Minutes meeting. And you can think of this as sort of like the three fates from Greek mythology coming together to decide everyone's destiny, because this is where they talk about where they think the economy is going and what to do about it. And remember, their whole goal is to bring that CPI number down from 8.2% that it's at right now down to 2% as fast as humanly possible without getting people to lose their job. And the way they do that is by increasing what's called the federal funds rate, which right now is at 3.25%. Hopefully you're with me so far. Now, after that meeting where we just found out what they talked about, the CME Fed Watch tool, which is just a tool that predicts future interest rates, actually showed an 80% chance that rates will go up to between 3.75 and as high as 4%. And what that means is that money is going to get even more expensive to borrow. Now, in that super secret / not so secret meeting anymore, there was one specific quote the Fed said that will help explain to you why the stock market will stay an up and down crazy roller coaster for the rest of the year. Because they said, quote, once the policy rate had reached a sufficiently restrictive level, it likely would be appropriate to maintain that level for some time until there was compelling evidence that inflation was on course to return to the 2% objective. Now that's a lot of complicated words, but what it means is that even after our last interest rate increase of the year, which will be on December 14th, when rates will reach 4.75%, even if inflation does go down to 2% from the crazy 8.2% that it's at right now, the Fed still wants to keep those interest rates high for a while before they start to lower them. It's not just Jerome Powell saying that, most of the members of the Fed agree with him. And because of what was said in that meeting is why the stock market will stay on a crazy roller coaster for the rest of the year. Now, obviously at this point we know that when interest rates go up, the stock market goes down. But what's sort of been left out of the conversation is how this will all affect the jobs market. And that's why we're starting to see new warnings from both economists and the banks that if the Fed gets its way and we go down to their target rate of 2% inflation, that as many as 5.3 million jobs could disappear. So let me explain exactly why they're saying this. Right now, the unemployment rate is at 3.5%, which means roughly 5.8 million people in the US don't have a job. Now, obviously this number is different from state to state, but on a national level, it's roughly 3.5%. Now, next year, the Fed is warning that that number will go up because according to what's called the Summary of Economic Projections, they're warning that starting in 2023, that unemployment rate will go up to 4.4%. So the question is, how many more people does that mean will actually lose their job? So I did some reverse math. It's not perfect, but you'll get a rough idea. Oh, and by the way, if you're an economist or a math whiz, please let me know why there's a discrepancy here because the Fed is telling us that 153 million people are employed according to the non-farm payrolls, excluding farm workers, right? That's how the Fed measures how many people have a job. And it says that 5.8 million people don't have a job. Now that actually works out to be 3.79% unemployment, almost 3.8, not 3.5% like they're telling us. So I'm not sure why there's a small difference there, unless maybe they're adding farm payrolls back into the equation somewhere. Either way, the math is not perfect. There's a small discrepancy, so you've been warned. But here we go. So if we had a 4.4% unemployment rate like the Fed is expecting to next year, that means we will have 6,732,000 unemployed people. Now that's a difference of 932,000. That means almost 1 million jobs will actually disappear. And that's insane because that's the Fed predicting that at best, they're about to go Zorg from Fifth Element on us.
Fire 1 million.
Now, I'm not trying to scare anyone into being afraid of losing their job because here's the most important takeaway from this. The Fed, remember, does not have a historically accurate track record of predicting these kind of things, and it's not in their best interest to. It's about to get really nerdy, but see if you can keep up with me. The Fed is kind of like the Oracle from the Matrix, right? The Oracle's job was never to tell Neo that his destiny was to become the one. Instead, the Oracle's job was to tell Neo exactly what he needed to hear to bring out the best in him. So in this example, Papa Powell is our oracle. In this case, he might be over-reporting the job losses because it might scare people into not spending more money and into saving more money because that would bring inflation down, which is exactly what his job is right now. Or he could be under-reporting those job losses because he doesn't want to scare people and potentially overcorrect. I don't know what his exact strategy is in this case. All I know is that to the Fed, psychology matters almost more than the truth. Now, when it comes to the private sector, though, you can think of the private sector as sort of like the agents in the system. Their job is to just beat you up and take all your money. And speaking of, Bank of America actually just said that unemployment will be between 5 and 5.5%. That's their estimate, which means as many as 2.6 million jobs could disappear at the rate of 175,000 jobs per month month in the first quarter of 2023, which is pretty crazy. Now, the good news though is that even if unemployment was as high as 5.5%, that would put us roughly here, which is about 2015 levels, which is nowhere near the level of the height of the pandemic. So it'll hurt, but hopefully not as bad. Now, when it comes to the stock market, Jamie Dimon, the CEO of JPMorgan Chase, says that the stock market could easily fall another 20% from here, and that could be true. But remember, Jamie Dimon represents the private sector. He is one of the agents. He directly benefits from convincing the Fed to increase interest rates, because when the Fed raises rates, banks raise their rates, and banks make more money when they lend at higher interest rates, right? So I'm not saying he's wrong, I'm just saying that the private sector has always had a reason to say what it says, which is why I don't always take it at face value, and I try to analyze both private and public points of views. Either way, I still think it's best to be prepared. And that's because according to Lending Club and data from payments, about half, or roughly 45% of Americans that are making $100,000 a year or more have reported living paycheck to paycheck, which is just insane to me, because I imagine most of those high-paying jobs are in the tech space, which right now is exactly the kind of job that is at risk of being cut. No one making 6 figures a year or more should be living paycheck to paycheck. So if that were me, I would drastically reduce my expenses and move to a lower cost of living area and start saving ASAP, especially considering everything that's going on, just to be safe. In the meantime, have a wonderful rest of your day, smash the like button, subscribe if you haven't already, don't forget to grab up to $250 worth of free Bitcoin right here, move it offline, don't forget to grab your free stocks, links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon. Bye-bye.